Well, just as you may already know, rocket companies just spent $9.4 billion with a B to take over Mr. Cooper Group. While the average American citizens are struggling to pay their home loans, the big lenders are out making deals knowing that they're playing a game only they can win. They call it a mortgage. You may have heard of it. But let's be honest, this isn't just about helping people buy homes. They're just making sure the banks stay rich, while borrowers keep sending in payments for the rest of their lives. Quite pathetic, if you ask me. Because why make money once when you can keep squeezing it out of the people just trying to keep a roof over their heads? Meanwhile, the average homeowners are feeling the heat. Loan rates keep going up, random fees pop up out of nowhere, remember the fee-fi-fo-fum fee? And people who thought they were finally getting a place of their own are realizing they're just renting from the bank. Now it's easy to guess who's celebrating. Of course, it's the big guys running the mortgage companies. Where do you think that $9.4 billion came from? It came from homeowners who will spend decades paying off a house they might never really own. Funny how that works, isn't it? Well, don't forget to like this video and subscribe. It's another rise and fall story. So just as I mentioned earlier, rocket companies just made a massive deal, spending $9.4 billion to take over Mr. Cooper. This isn't just any small deal, it's a really huge shakeup in the mortgage business. With this buyout, Rocket is getting even bigger, giving them more control over mortgages and the rules behind it. They've said this will make things better for customers, but when fewer companies run the show, it usually means less competition and fewer choices for average citizens. Mortgages have been a big part of American life for decades, but deals like this ruin most Americans in ways they don't even realize. The more power these companies have, the more they can control how these mortgages work, and that doesn't always end well for borrowers like us. Rocket has built its brand on making mortgages look quick and easy with flashy ads and smooth online ads. Mr. Cooper, on the other hand, has been focused on servicing loans and helping people refinance. But here's the true question. Does this deal actually help homeowners, or just make Rocket more money? With Rocket taking over, they're not just expanding their business, they're setting the rules on rates, fees, and loan conditions in ways that can make borrowing even more expensive. At the end of the day, it may always seem like a bigger company might offer some convenience, but actually, it also means less competition and fewer places to turn if you're looking for a fair loan deal. And in an industry that already favors lenders over borrowers, putting more power in the hands of a giant like Rocket might not be as great as you think. Mortgage companies make more money when people take longer to pay off their loans, since that means more interest piling up. A bigger and more powerful Rocket could make things even messier for borrowers, piling up mortgage agreements with sneaky little hidden traps. While with home prices climbing, mortgage rates bouncing around, and owning a place getting harder for the regular US citizen, the big lenders are cashing in on all of it. The more complicated and expensive the home ownership gets, the more these companies rake in. Let's say you buy a house for $300,000. With a 30-year mortgage at 7% interest, your monthly payment, excluding taxes and insurance, would be around $1,995. Over 30 years, you'll pay a total of $718,000, more than twice the original price. Now, suppose interest rates rise and you struggle with payments. You refinance, which means more fees and extending your loan term. Companies like Rocket Mortgage profit from this cycle, making billions while homeowners stay in debt for decades. A typical mortgage runs for 30 years, which means a person could spend most of their working life making payments. And here's the thing. When you add up all the interest, the total cost of the home ends up being way higher than the sticker price. Have you ever stopped to think about how much extra you actually pay? A homeowner can easily end up spending 2 or 3 times the original price just from the interest rate alone. Let's be honest, banks and mortgage lenders aren't in this business to do people favors. The longer someone stays in debt, the more these companies make. On top of that, homeowners deal with stuff like property taxes, insurance, and repairs, making the whole thing even more expensive. If you pay off your mortgage early, the lender loses future interest. To make up for it, they charge a penalty, basically a fee for ending your debt too soon. It seems like a lose-lose situation for all of us, doesn't it? The prepayment penalty is usually about 1 to 2% of the remaining loan balance. For example, if you owe $100,000, the fee could be between $1,000 and $2,000. Another way the mortgage system keeps Americans stuck in debt is through refinancing. When interest rates drop or people's income change, homeowners are pushed to refinance their loans. While this can lower monthly payments, it usually resets the loan term, stretching the debt out even longer. Someone who refinances a 30-year loan after paying for 10 years could be looking at 40 years or more of payments. That works out great for the banks and lenders, but not so much for the borrowers. You guys, you should all be mad about this, because I am. The idea that owning a home brings financial security isn't always true. A lot of homeowners struggle just to keep up with payments, and when they fall behind, foreclosure or financial problems can hit hard. On top of that, the housing market is all over the place. If home prices drop, people can end up owing more than their house is worth, making it nearly impossible to sell without losing money. With all these risks, plus the ridiculous cost of borrowing, it's pretty clear mortgages are set up to keep people in debt for most of their lives, keep the poor people poor and the rich people rich. Government policies also help to keep this system going. Programs like FHA loans, VA loans, and government-backed mortgages make it easier for people to buy homes, but they also push you into huge debt. These programs actually make it easier to get loans, but they don't do much to protect buyers from shady lending practices or the long-term financial stress of mortgages. Ever wonder why there aren't stronger protections to stop homeowners from getting trapped in these loans? Not to sound like I'm a tinfoil hat wearing conspiracy theorist, but it's kind of all part of the plan. A big reason people stay stuck in this cycle is the Federal Reserve's control over mortgage rates. When rates are low, people are encouraged to take on more debt. But when rates jump, those with adjustable rate mortgages see their payments skyrocket, sometimes so high they can't afford them. This forces homeowners to refinance, take out home equity loans, or even sell their homes just to keep their heads above water. No matter what happens, banks and lenders keep making money while you fight to stay afloat like Leonardo DiCaprio in the Titanic. The tax system gives homeowners a break on mortgage interest, but the people who get the most out of it are the ones with big, expensive homes. Richer citizens save more on their taxes, while the average citizen still deals with high costs. Instead of actually making it easier to own a home, these policies just make debt seem normal, like it's just part of the deal. Again, keep the rich rich and the poor poor. Fannie Mae and Freddie Mac, the government-backed mortgage companies, those sound like goofy names. Anyway, keep this whole debt cycle running. They buy mortgages from banks, letting them offer more loans. This helps more people get homes. Yay, right? Wrong. It also encourages banks to approve riskier loans, knowing Fannie and Freddie will handle the debt. That sounds like a sitcom. How can anyone take that seriously? The focus is on pushing homeownership without considering the long-term financial burden it creates for borrowers. Instead of fixing the real issue, which is reducing the cost of owning a home, quick, easy, simple, right? Government policies just keep feeding the cycle. They're not in the business of making homes affordable, they're in the business of making it super easy to borrow money. With all these, some people are looking for other ways to own a home without being stuck in a loan for decades. One option is saving up and buying a house outright. Though, that's tough when wages aren't keeping up with prices, and you don't have the time machine from Back to the Future. But for those who can stick to a strict budget and look at cheaper housing options, it's a way to avoid throwing money away on interest and stressing over a mortgage for the rest of their lives. Another option is cooperative housing, where people share ownership of a place instead of buying it on their own. Tiny homes and modular homes are also cheaper ways to own a place without taking on a mountain of debt. And honestly, if I didn't have the house that I live in now, I would probably have a tiny home because I think they're really cool. Some financial experts suggest rent-to-own deals, where tenants slowly buy a home over time without needing a huge loan up front. Community land trusts, CLTs, offer another way for people to own a home without dealing with crazy price hikes. In this setup, you own the house. However, the land stays under community ownership, which keeps costs down. These options won't work for everyone. You just have to be careful. If not, you could go from the rise of owning your home to the fall of debts. You know the saying, the higher the rise, the harder the fall. Stay safe out there. be sure to take care of yourselves.